Hello and welcome one and all. Thank you so much for joining us for this Chabad virtual presentation titled Pandemic Investing with Noah Dreyfus. My name is Rabbi Zalman Mendelson, and I have the pleasure of serving as the co-director of the Chabad Jewish Center of Wyoming, together with my dear wife, Razy. It is a great pleasure to welcome those of you who are joining us for the first time and those familiar faces who we love to see as always. The schedule for this evening is we will begin with a 30-minute presentation that will talk about investing during this time of our lives, where the many challenges that we are experiencing in the world today create all kinds of challenges and opportunities, followed by 30 minutes of Q&A. No part of this program suggests that Chabad is encouraging any investment strategy or idea. We recommend that each and every one of you do your own personal due diligence before you invest in any product or company. It is a great pleasure and an honor to have Noah with us here this evening. Before we get started with this event, I'd like to bring to your attention several other events that we have upcoming, which we would encourage you to join us for. First and foremost, this upcoming Thursday at 7:30 p.m., we will be hosting Israel's Consul General for an update on all things going on in Israel. It should be a fascinating discussion, particularly now with the challenges on the borders of Israel with Lebanon and Syria, the challenges that are taking place with regards to regional troublemakers such as Iran, etc., etc. This will be an open discussion with Israel's Consul General, where we will dig into the details and uncover all of the necessary information that is current in our insider perspective with the Consul General. Then, September 6th at 9:45 a.m., that is in the morning, we will be hosting Minister of Diaspora Affairs, Omer Yankelevich, the first Israeli Haredi woman minister to serve in Israel since its founding. Her story is fascinating, growing up in a secular family, becoming observant and more religious as a youngster, going off to become a very successful lawyer, finally founding an organization to bring together the different groups that are often separate in Israel, bringing them together in a state of unity, and ultimately running for office, becoming the first minister in the history of Israel that was a woman and Haredi. Her life story is fascinating. You don't want to miss these events. Now, it gives me great pleasure to invite Noah to this evening's presentation. Noah originally was educated as an Orthodox rabbi. From a young age, Noah attended rabbinical seminary from 2006 to 2010 in the great city of Jerusalem. Noah found a talent for investing in equities during the 2008 Great Recession, which proved to be his future career path in investing. Combining a passion for both planning and detail, Noah spent the majority of his career at AXA Advisors, Merrill Lynch, and Citibank. Noah elected to go independent in 2020, reflecting a wish to serve in a fiduciary-only capacity as a fee-only advisor and be free to pressure to sell commission-based products. We know about all those commission-based products which are often forced down our throats. We don't like those products. Much along the lines of his faith-based education, the emphasis of his practice is on goal-based planning. Once goals have been established, Noah takes a unique approach to risk management and designs a bespoke portfolio to each client's individual needs. Having an open architecture investment platform, investors can benefit from Noah's expertise in equity markets, private equity analysis, and real estate investing. Noah specifically focuses on companies that are solving our greatest social and environmental needs. Noah resides in Jackson and is a new and beloved member of the Jackson Hole Jewish community. Having spent many years living in the Rockies and DC area, Noah's clientele range from New York, Maryland, DC, Virginia, North Carolina, Texas, Wyoming, and Colorado. Noah is an avid snowboarder, hiker, and nature enthusiast. Please put your hands together for a warm Chabad welcome to Noah Dreyfus.
Thank you very, very much. I'm going to share my screen here, and this is going to be an interactive presentation where I'm going to show different data points, and we're going to analyze different subjects of investments from equities to bonds in the current COVID environment. It is extremely important to note that no recommendations of specific investments are going to be made tonight. Any stocks, funds, or mutual funds that we are going to discuss is purely from an educational standpoint and to illustrate certain points. If you are seeking investment recommendations, I would consult with me privately or whoever you work with currently. With that being said, we can get started. Okay, so over the past 10 to 20 years, since really the early 1990s, investors have typically gravitated from individual positions such as stocks and bonds to mutual funds and exchange traded funds. And typically the reason for that is diversification. So investors in mutual funds or exchange traded funds no longer have to make decisions regarding the sector or asset type that they are exposed to. However, many investors assume that by being invested in a fund, they are by nature diversified. This is a misconception. Many funds are not diversified and are often overweighted towards specific companies. So, for example, the most popular index that investors are exposed to, which encompasses 60% of US investors, is the S&P 500. What investors may not know is that the S&P 500 is not equally weighted across the 500 companies that it covers. If you see on the right here, this is data from Morningstar.com, which is an independent third-party fund rating service. And they will actually go into the portfolio and look into how things are weighted across the S&P 500. And what you'll see here is that the top 5 tech companies encompass more than 20% of the current S&P 500. To further extrapolate, 50 or 10% of the S&P 500 is currently weighted in S&P 500 funds towards 50% of the total allocation. That means the other 450 companies that are in the S&P 500 have a very small weighting individually when investors are looking at S&P 500 funds. Another example of this is in a very popular fund right now is symbol XLK, or the Spider Technologies Select ETF, or exchange traded fund. While an investor may think they are buying a diversified portfolio of tech companies, the reality is much different. Over 24%, if you look to the right here, 24%, almost 24% of XLK is in Apple, and over 21% of XLK is currently in Microsoft. This is what you would call an under-diversified portfolio, meaning if an investor were to buy these funds, they would be overexposed to select tech companies and underexposed to the rest of the technology sector. Another concern is exposure to companies in aging sectors. For example, The oil industry is currently undergoing a major restructuring as oil demand has dropped and climate change weighs on the sector. Owning mutual funds and exchange-traded funds will lead to exposure in the oil industry. Most investors will agree that energy production from fossil fuels will eventually give way to renewable energy sources as climate change weighs on sustainability. Additionally, investors seeking exposure to next-level technology companies often only gain exposure after a large acquisition. Examples of this are Facebook and Salesforce, which only became part of investors' portfolios in the S&P 500 several years after they debuted on the markets. There are many small and medium-sized technology companies that are acquisition targets for larger tech companies such as Twitter, Microsoft, Amazon, and Google. Upon acquisition, typically the acquired company's stock sees a significant rise in value, as opposed to the acquirer, which will often see a fall in value. People or investors paying attention to the news this week, there was a discussion of the acquisition of TikTok by either Microsoft and Twitter is an example of this, where Microsoft and Twitter will shell out large amounts of money, often in the billions of dollars, to acquire smaller technology companies, leading to a rise in the smaller company's value in its equity price. There's been a lot of talk over the past several years about value versus growth investing. Technology companies during COVID have significantly outperformed value stocks. However, this trend is starting to adjust as we get closer and closer to a vaccine. For example, I picked a select handful of value companies versus growth companies that are representative of individual sectors. We can start off with AES, which is an energy company, but is not specifically focused on oil. Most of AES's investments are in the renewable energy sector. If you look over the past 1 month, the stock has seen a significant rise in value. Once again, I'm not making a recommendation as to any stocks that we discussed tonight. However, if you look over the past year, it had a very difficult time recovering from COVID and only recently started to spike in price. The same is true for MGM Resorts International. While over the past month, we've seen a significant rise in the stock value. In fact, yesterday it jumped almost 15%. In the past 1 year, it has had an extremely hard time recovering from COVID. This is due to the hotel industry being largely shut down when travel was shut down. Boeing is another example of this. It is the largest airplane manufacturer in the United States and one of the largest in the world. Over the past 1 month, it has started to recover slightly, not quite the same level as MGM and AES, but if you look over the past year, for factors outside of COVID as well, it has had a very hard time recovering. Bank of America, the largest bank in the United States, by deposit share. JP Morgan is a larger institutional bank, but by deposit share, Bank of America is the largest bank in the United States. Over the past 1 year, it had a catastrophic collapse, but is starting now to rise. Juxtaposing those value stocks versus your classic software companies. Over the past 1 year, Microsoft has had a huge surge in value, even with COVID included. But over the past 1 month, it has stayed stagnant to falling in value. And the list goes on. Netflix, over the past 1 year, huge surge in value as people are staying home and utilizing the service. But over the past 1 month, it has seen a drop in value. These are some of the ways that COVID, as we get closer and closer to a vaccine, is going to adjust the investment landscape. Ultimately, companies have a fair value in terms of the amount of revenue that they increase. When a stock is undervalued, typically when the single source event is cured, meaning COVID is a single source recessionary event, when that is cured, a lot of these companies will go back to their original book values as travel, banking, and the energy sector recover. The second part of this presentation is not about equities, but rather bonds. Many people, as they get closer to retirement or in retirement, utilize bonds as safe havens against stock market volatility. This concept has long been held as true and hasn't been reconsidered in a long time. The concept behind a bond is very different from an equity. An equity is an ownership in a company, and so as that company rises and falls in value, you in turn as the investor rise and fall in value. Bonds are loans where the lender is the investor and the recipient of the fund is the bond issuer. In the past, investors bought individual bonds as safe havens to protect assets from stock market volatility. Since loans pay fixed interest, investors considered them safer than stocks. After the savings and loan crisis of the 1990s, in which bond investors lost tremendous amounts of money, investors began to use bond funds to diversify themselves from credit risk. Bond funds, similar to stock funds, are baskets of hundreds or thousands of bonds. Wrapping this basket of bonds under a single wrapper allows investors to have more liquidity and diversity in owning bonds. Since bonds have maturity dates in which they expire, investors owning individual bonds historically had to wait for the bond to come to maturity to get their principal back. Now with funds, investors are able to move in and out of bonds similar to equities. However, when you package several hundred bonds under a liquid wrapper such as a fund, investors may forget that selling bonds prior to maturity will subject them to something called interest rate risk. The two main risks to bonds are interest rate risk or market risk, or the risk of default and bankruptcy by the issuer called credit risk. Since interest rates have varied widely in the 10+ year time frames, bonds can actually be more volatile than equities in a long-term horizon. When interest rates rise, investors or fund managers selling bonds are forced to sell their bonds at a discount because the current interest rate is higher than the interest rate that is paid by the bond they are selling. Inflation forces bond interest rates or yields to rise. In a zero interest rate environment, a major concern will be if inflation forces yields to rise, in that event, bond funds will fall. Gold prices are one of the several indicators of the rise of inflation. Since precious metals are stores of value, investors holding US dollars that are falling in value due to inflation will typically buy gold as a hedge against inflation risk. As you can see in the graph to the right here, the price of gold has been rapidly rising over the past 6 months, as measured by the world's largest gold fund. This is largely due to central banks printing large amounts of currency to supply liquidity in the markets during COVID. This may be an indicator that inflation will rise, and in turn bond yields will rise, causing the value of current bond funds to fall. When interest rates are high and then go lower, bond funds increase significantly in value. By looking at the graph on the right, between 2018 and 2020, when the Federal Reserve had a continuous policy of lowering the interest rate, a sample corporate bond fund saw a huge, tremendous spike in value, aside from a few weeks during March due to COVID. In contrast, When interest rates were low but rising from 2016 to 2018, bond funds fell in performance during this window. Another factor when considering using bond funds is that when there is recessionary risks such as March of 2020 in this spectrum, bond funds fall in value due to expected default risk. If the entire economy is collapsing, it is widely known that a lot of companies will go into bankruptcy. When a bond issuer defaults, there is the risk that the lender, you as the investor, will not get paid back from the issuer of the bond. With yields between 0 and 3% in bonds right now, investors need to ask themselves if the downside risk to the right here of 10+%, either due to market or interest rates rising, or credit risk because of a resurgence of COVID, is worth the 0 to 3% interest received from bonds, especially if interest rates were to rise. Remember, when interest rates are low and then rise rapidly, bond funds fall in value. Additionally, 77% of S&P 500 companies are currently issuing a yield higher than the highest yielding US Treasuries. Investors seeking income in retirement are being forced to consider equities over bonds, which will eventually lead to a sell-off. So the question is, how can we find value in a market driven by a pandemic? With 60% of equity exposure being in index funds, small cap and medium cap companies are largely left untouched by retail investors. Some of these companies have moats that allow them to thrive even in recessionary economies. We use a proprietary model to research these companies. We then segment these companies into core, value, and growth segments. Case study number 1, Dollar General. Dollar General is a publicly traded chain of dollar stores spread across rural towns and cities in America. Its competitive pricing and branding have made it a staple in rural communities seeking low-cost home goods and supplies. In seeing price-to-earnings multiples of 22 to 1 plus on the S&P 500 in January of 2020, the fund placed a 2.25% investment in Dollar General. Dollar General has little exposure to index investing and is well prepared for a recession or economic downturn by taking over market share from companies such as Bed Bath & Beyond. While Dollar General did decline in March of 2020, as you can see to the right here, the recovery was swift and outpaced the S&P 500 significantly. Case study number 2, CrowdStrike Holdings. CrowdStrike Holdings is a next-level cybersecurity company using artificial intelligence to analyze and detect hackers before they gain entry to cloud-based system platforms. Notable clients are Amazon Web Services, Goldman Sachs, ADP, Credit Suisse. CrowdStrike is a small cap company with no index exposure to the S&P 500. Therefore, if you held an S&P 500 fund, you were not exposed to this company. Therefore, its shares are widely held by institutional investors. CrowdStrike will be widely utilized as cloud computing and its security come to the forefront of concern for major companies. As you can see to the graph here to the right, CrowdStrike varied between $60 and $40 a share, but in the aftermath of COVID, jumped significantly and almost tripled from its low. Another model of looking for investment opportunities is fear and greed in the markets. As Warren Buffett famously says, when investors are greedy, I'm fearful, and when investors are fearful, I'm greedy. As markets cycle from expansion to contraction, The relationship between fear and greed is one of the strongest indicators of market momentum. I take a cautious approach to greedy markets and a proactive approach to fear-bound markets. This contrarian system seeks advantage in recessionary markets while maintaining a long-term bullish market stance. The way in which I typically transition a portfolio from value to growth is in these market cycles where you see the VIX, which is a fear gauge, spike in interest. We prepare for that by looking at the VIX when it's low. If the VIX is low and too low for too long period of time, that means we're approaching a bubble in a market. I then segment as we discussed earlier, I segment companies into 3 core segments. Core segment is examples like Amazon and Costco are large to mega cap companies with dominant market share sectors that provide strong long-term value and growth. Value are companies such as Dollar General and Clorox, which produce staple goods and services that we feel are undervalued but have strong market share. I'll pause here for any questions.
This is Chabad investment.
Victor, you're on mic. Any questions?
No, I just joined.
Oh, welcome.
Thank you.
I have a question. Yeah, I do. I've become probably conservative financially to the nth degree since I retired. And I've got significant savings in my 401k, which is just sitting in a money market fund making 1%. And I know I can do better, but I'm totally risk averse. What do you recommend for retired people?
So risk management, as per the introduction, is very specific to the investor. I use a system where we analyze what is your maximum risk tolerance on the downside and what is your what do you expect on average on the upside. So that way, when markets go from recessionary environments to bull markets, we're able to cater your portfolio and your investment portfolio to your specific tolerance. However, and while I cannot make recommendations to individual investors in a public format like this, and I would love to sit down with each and every one of you, ideally you would begin to invest those funds because inflation is a very big concern in the current environment. When the Federal Reserve is almost doubling the amount of currency and supply in the system, the value of the dollars you held the last year are going to be worth a lot less next year. That with those 1% money market yields are not going to keep up with long-term inflation, even when inflation has been historically low. So you mentioned the 1% yield on a money market fund. Inflation has varied between 1.5% to 2% pretty consistently over the past 5 years, and we would consider that low inflation. So even when we have low inflation, the money market is not able to keep up with the cost of goods over time rising. I'm sure I remember when I was a kid buying cans of Coke for 25 cents a pop. Now you walk into Albertsons or Smith's, you can't get one for less than $1. So that rise of consumer goods in terms of price is going to eat away at the value of the cash held. And so a good investment strategy is balancing risk with what you need for income and what is sustainable for you to stay invested for the long course. I hope that answered your question.
Yeah, it answered my question, but tell me how sick is the corollary to that, which I'm going to say, I feel that I have substantial savings that even with inflation, I won't outlive my money, and that's why I've left it in 1% places. I
Okay.
also have, well, I sold a house 4 years ago, the house that I lived in for 30 years. So I'm in New York City, so I always call it New York dollars. I have 6 figures from the sale of a small house in New York, sitting in the bank, earning 1%. That's in addition to the money in my 401k, to be perfectly frank with you.
Okay.
So I've got all this money sitting around earning 1%, and I figure I'll die before I spend it. That's why I left it where it is.
Okay.
Like I said, how perverse is that thinking? I know there's something wrong with it.
Your individual priorities are your individual priorities, and your ability to take on risk is an individual decision. That's something that we can kind of take out of the Zoom chat as a private conversation. I would love to have that conversation with you. Some things to consider, when utilizing that strategy is the eventuality of long-term care and health costs rising. So healthcare inflation rises between 5 and 8% per year, and long-term care insurance policies are going the way of the dinosaur. So investors self-funding through long-term care, which is going to affect 50% of the current US population, will eventually end up in some sort of long-term care or assisted living, is a concern. But I would sidebar that specific getting too in detail, personally, and we can revisit that in a private chat. Is that okay?
Yes, that is a great suggestion. We have a question that came in from Jessica. Jessica, did you have a chance to ask your question yet? If you'd like to go on mic, take off your mute and ask your question directly to Noah, that would be great.
Yeah, just rewinding a little bit. I have just the question about the mutual funds versus what's happening in the market. Are the funds ignoring the changes that are happening? Because they're very, you said they're very tech heavy, and then there's these value companies they're ignoring that are actually stable right now. Are any of the fund managers adjusting for that?
So index, exchange traded funds are passively managed, which means they follow a protocol. In the case of the S&P 500, which encompasses 60% of equity investments, those investments are strictly following the pattern of size. So as Apple rises in size, the share of Apple inside that fund goes up. Same with Amazon, same with Microsoft. However, Dollar General is not competing for size, with Amazon. So as Amazon rises in size within a fund, a company like Dollar General will fall in representation within that fund. And so, yes, there are adjustments, but they're not made with the idea of balance. They're made with a set protocol and math that is not managed by an active manager, if that makes sense.
Yeah, it does.
Thank you very much for that question, Jessica. Judy, you had written me a question. Would you like to come on mic and ask the question to Noah directly? I think it would be most helpful to have your voice and for us to see you. We miss you a lot. Please come on and ask your question, Judy, if you're you're up for it.
Press
you're on-
Alt-A. Hold on. Alt.
do it one more time.
T.
You're on. You're up. You're there. Just hold it. We can't hear you. We can't hear you.
There you go. Don't press it.
Is that unmuted?
Yeah, we can hear you now.
Okay. Okay, I was going to say, then just read my comment. I would love to hear some take on why the market's so exuberant when we're having so many economic issues. Businesses are out of business, malls are closing, restaurants are, you know, I have a nail salon of 15 manicurists and only 4 can work at a time. And the market's exuberant when we have a vaccine. What's going to happen? How do we prevent crashing, if it will? Or what's going on, and how do we plan for the future under these bizarre circumstances?
Yes, so this is probably the most common question that I receive from prospective investors during this environment. The answer is threefold. First of all, the rise in the markets. When we say the word market, the most utilized measure of markets has been the S&P 500. And as we discussed earlier, over 20% of the S&P 500 is tech companies. Tech companies have been swallowing market share from smaller retail companies as retail companies are forced to shutter. Like you mentioned, you're no longer able to take on the amount of clientele that you've had. That's probably led to, I'm not familiar with the beauty care industry in particular, because I'm not a purchaser of the products, but I assume there's some sort of market out there online for people purchasing their own sort of manicure products and hairstyling products as they're stuck at home or as they're nervous to come into stores or can't get appointments for that matter. So when we measure the markets, it's important to understand that the markets are currently skewed by the tech companies in their size. The second part of that is that there are companies that are going to go by the wayside. Travel, hotels, hotels specifically for business travel in areas like, I would say, rural Texas, where people go strictly for business meetings, there's really no travel or leisure involved, are going to have to start shuttering at some point, because people are realizing how effective this call is, this Zoom presentations are. And so a lot of the industries that we're familiar with in the economy are going to go to the wayside and are no longer going to be prevalent. However, I don't think people are going to entirely give up their hairstylist and their manicurist because of a 1 to 2 year pandemic. Things will eventually come back in a lot of industries that are heavily affected right now. So adjusting your portfolios from that heavy tech exposure to a lot of the companies that are going to fare well over the next 1 to 2 years, but being able to be patient with that is going to be pivotal for investors. Did that answer your question?
Great question and great answer. Jason Bloomberg, would you like to come on mic or open up your video? We'd love to see you, or you can just ask your question directly to Noah on mic. Please go ahead.
Noah, I was wondering what your take on life insurance retirement plans are, LIRPs. I got thinking about it because of the situation with our rabbi in Cheyenne, who presently is in hospice. He has no long-term care insurance. And so basically the community's been having to raise funds to help cover those expenses so that he can have a dignified remainder of his life. And if anyone wants details about that, they can see the Mount Sinai Cheyenne website. But, you know, I'm thinking about planning ahead for myself. I'm not quite ready to retire, and I've been approached about LERPs through solicitations. So I just wanted to get kind of an outside take on it. Thank you.
Yeah, absolutely. Life insurance as a form of investment, I always like to say that insurance companies are there for their own best interests. Investment advisors are there for your interests. So insurance companies make a large amount of money from selling insurance plans to investors. I've seen a tremendous amount of investors invest in long life insurance retirement plans with the wrong ideas. However, you did bring up that that long-term care policies, the fact is that they're going the way of the dinosaur. They are too expensive, people are living too long, and the insurance companies are realizing that they can no longer make money on them. Companies like Genworth, I believe, is the only company still issuing standalone long-term care policies. And long-term care policies are billed, which means that you have to pay the bill to the healthcare provider. Then you have to submit that bill to the insurance company. Anybody that's dealt with insurance companies knows that they'll find any possible way they can to not pay that bill. So an alternative strategy people have used is to buy permanent life insurance policies that have a special contract provision that allows you to use the death benefit of the life insurance policy for long-term care. That is a legitimate strategy. However, using life insurance to supplement your retirement income can get extremely precarious. And if you want more information about that, I would sidebar that because it's an extremely complicated conversation that can go well over a half an hour. But there is value in taking out a life insurance policy with a long-term care provision so that you can hedge against the risk of outspending your money due to healthcare. I hope that answered your question.
Thank you very much for ending each answer with, I hope that answered your question, because sometimes it's hard to know if the questions were answered. I thought it was very comprehensive and detailed, and that was great. Thank you very much for sharing that. We have a question from Aaron Weinberg. Aaron, please go ahead.
Okay, thank you very much. It's a great presentation, very much appreciated. With easy money policies of the Fed and the government spending trillions of dollars, the US dollar is going down in value, is there a place in the future where Bitcoin is going to become and other cryptocurrencies going to become more mainstream and something to think about as some investment mechanism?
Excellent question, and I'm more used to this question from my younger clients, but it's amazing that you're thinking in this stream. So, cryptocurrency is a very difficult field of study. The reason for that difficulty is that while Bitcoin can act as a hedge against inflation, it oftentimes doesn't. So if you look back to the COVID markets and what happened to Bitcoin, Bitcoin fell from the $10,000 range all the way to the $5,000 range in a matter of weeks. Most investors cannot handle that level of volatility. Okay, gold did not react that way in the same level. And so using it as a hedge against inflation is not 100%. There are ways in which Bitcoin can act as a hedge against inflation and ways in which Bitcoin acts in tandem with the markets. I would view Bitcoin as a speculative play, if at all, in your portfolio. Meaning, if you choose to invest in a cryptocurrency, I would be 100% comfortable with losing every single penny that you put inside of that investment.
Okay.
If you are comfortable with doing that, it could be a good supplement for the future. There is reason to believe that as central banks flood currency or liquidity into the markets, especially third world economies such as Africa, South America, and Southeast Asia that don't have a stable currency, that countries or people in those areas of the world will be forced to use cryptocurrencies as a means of transferring value. Whether that holds up the price of where it is currently, I cannot say for sure, and I don't recommend to any of my investors investing directly in cryptocurrencies unless they say to me, "Hey, no, I got $1,000. I wanna gamble, and I'm cool with losing all of it." Okay. So then I say, "Okay, all right. Well, it might not be the worst idea in that specific scenario."
Okay. Thanks so much. Thank you.
Absolutely.
Thank you very much. Rhoda, I saw you typed a question. Please go ahead, unmute yourself and ask your question directly to Noah.
Thank you. Thank you, Noah. How do you feel about the competition online? For example, Motley Fool, the competition, which is basically trying to be rather general, but yet specific in terms of guiding you through your investment skill set and then actually picking some stocks for you with rather fairly significant research supporting it. I wish you a great career, but the reality is I think there's something appealing about that, and they have something to offer. What's your take on it? I'm not very familiar with it all.
Absolutely. So just as technology has revolutionized pretty much every industry, the financial world is no different. And so robo-advisors such as Schwab Intelligent Portfolios, Merrill Edge, I believe, or subsidiary of Merrill Lynch has a robo-advisor program. Those are becoming more and more common. What I would say is that a lot of those robo-advised funds have performed, have not kept up with the S&P 500, and the S&P 500 has not kept up with a lot of active managers over the past year. And so people closer to retirement or in retirement are going to have a hard time holding on to these funds long term, as they don't analyze risk in terms of your preferences. What they do is they follow a certain analytical model that a bank or a company puts out. And so these robo-advisors are not speaking to you, the client, and they don't know how to invest for you specifically. Now, for younger investors, people in the 20 to 40 range, I believe robo-advisors provide a significant value to investors, because a lot of investors, in the younger range don't really need specific advice. They're willing to roll with the markets and let whatever money they have ride. So when you're an investor with that sort of ultimate growth goal, it can provide significant value and it can save you on fees. However, when you need more advice and you need somebody to distribute your income from investments, to determine dividend yield, to analyze the sustainability of your portfolio throughout retirement, and make risk adjustments if you're not keeping up with the amount of money you're going to need over time, I feel in that population segment or demographic that I have no worries as to the longevity of my career.
Thank you.
Does that answer your question?
It sort of does. I think the element of researching possible stocks possible equities, even mutual funds that have great potential. Sometimes these online services like Motley Fool do a really spiffy job, something that the average person can't do. It takes really hours at the computer to try and find out all the background research and history of many of these companies that will give you a sense of whether there's potential there and what the future is like for them. So I'm rather impressed with some of the research. On the other hand, I agree they don't know me personally and my preferences.
Exactly. And so catering risk to you as a specific investor is what I try to focus on. I have clients that are my age in their 30s, and I have clients, you know, upwards of 70. And so I do believe that there is a market for individual catered advice when it comes to investing.
Thank you.
Yes, absolutely.
Thank you very much for that. Joshua, where are you tuning in from, Joshua? Let us know where you're joining us from, and please come on mic. We'd love to hear your question directly to Noah.
I'm tuning in from Sydney, Australia. I'm Victor's son, who's a current listener of yours.
I had a feeling that was the case. We're so glad you're joining us. Thank you for being a part of this. Go ahead, Joshua.
Thanks a lot. Yeah, Noah, I'm just interested in your thoughts around, with the current market uncertainty in the world, are you advising clients to look at uncorrelated asset classes, for instance, secured private debt?
In certain respects, yes. So income-driven investors that are seeking access to income streams that are not correlated to the bond markets and interest rates in general, it can be advantageous. There is a tremendous amount of due diligence involved with that. And there are regulations on how private investments can be offered to investors within the United States. I'm not sure how it works in Australia, but there are significant minimums in terms of net worth to access these funds. But yes, I do, for investors who are qualified investors, I do provide access to private real estate funds, which essentially you become the mortgage lender to private, whether those are residential or commercial, depending on the fund availabilities. These funds are not traded on open markets, so essentially what's available when you're shopping for them is what you're going to get. And they are not liquid in the sense that you can just pull your money anytime. So it is for a very specific type of investor that understands the risks involved. And like I said, I don't make any broad general recommendations to anyone. Everything is catered to the specific investor.
Thank you.
Now, Noah, if anyone else has any questions, please just unmute yourself and ask away. Feel free to join the conversation. I do want to ask you, Noah, before anybody does decide to ask their next question, if someone would like to reach you to learn more about the work that you do, to learn about the possibility of maybe having an hour or a half hour initial conversation with you to see if they would be interested in using your services, do you offer that? Is that something that you're available in person, over the phone? How does that work? Share with us.
Yes. So, you know, with the typical demographic that I meet with, a lot of investors are hesitant to meet in person. So I offer accommodations, whether you'd like to meet in person, whether you'd like to do a Zoom presentation, whether you'd like to just have a phone call or do a socially distanced coffee at one of the local cafes here in Jackson. You know, I am available to meet with clients. That meeting is complimentary. I don't charge anything for it. If anybody would like to take down my phone number or my email address, you know, I can put it here, here in the comments to everyone. I'm going to write down my phone number here and my email address as well.
And if you could also put in your website, that would be great so people could do a little more research.
Absolutely.
Great. Awesome. Any other questions that we have before we call it a night? This is a final question, final opportunity to ask a question before we sign off. Any final questions? Robert, I see you unmuted yourself, or you're not on mute. Would you like to ask a question? Avi, we'd love a question from you. Please come on up. Unmute yourself. Feel free to ask any question you'd like. If anybody has any questions, we'd love to hear your questions, please.
Noah, you're a fiduciary, I
Can you hear
assume,
me?
right?
Yes.
Yes, that is correct.
Hello,
So,
can you hear me?
yes. Judy?
Okay, this is Judy. Yes, good. What does it stand for? Dreyfus is U and WM, so it makes it easier to remember.
Wealth management.
Your web wealth management. Thank you. Makes it easier to remember. Thank you.
Absolutely.
I have a question.
Please go ahead.
Good.
Do you think a lot of these travel stocks that have gotten beaten up, over the last 3 or 4 months, have the potential to recover if a vaccine is, imminent? The airlines, the cruise stocks that are, below 50%, sometimes more of what they were at their peak. Is there room for them to go up at least 30, 40%? Maybe not to the high where it was, but at least to crawl back to somewhere close to that?
So I'm not going to talk in terms of actual percentage appreciation, and I would divide it into 2 categories. There are going to be your travel companies that are going to see an increase in business over the next couple of years due to people being so just stuck in New York City, stuck in LA, stuck in large cities, and they just need to get out. There are going to be travel companies that are based on business travel, which are going to have mass defaults, and there's going to be a lot of commercial real estate available on the market in those sectors. So really, it's not across the board. I would say cruises may be the most affected long-term of the companies that are going to stay in business. So of the cruise companies that are going to stay in business, people are going to have a very hard time phobia-wise committing themselves to a 1 to 2 week adventure where they have no certainty about getting back on the shore. I think there's a lot of trauma involved with that, and there are a lot of people who were on cruises during the COVID pandemic when it was at its height that had a very, very negative experience. And so I wouldn't say that travel is going to recover across the board, but I do believe there are ways to invest in those sectors responsibly and take advantage of some of the appreciation as the vaccine comes closer.
Okay.
Any
I hope
follow-up?
that answered your question.
Yeah, it helped.
Well, thank you, Noah, very, very much. Let's put our hands together for that fantastic presentation. Really, really appreciate this. This was fantastic. Again, this upcoming Thursday, we'll have a no-holds-barred discussion with Israel's Consul General to talk about all things related to Israel. Lebanon in the north, Syria, Iran, what's going on with Hezbollah, that recent blast that went off in Beirut, how all these things together are affecting Israel's safety and security. If you're interested in the current COVID response that Israel has, all things related to Israel's political and both its domestic and its international relations, these things are going to be on the table for discussion. Please join us this upcoming Thursday night at 7:30 p.m. Mountain Time. We would love your participation. Finally, I would like to recognize our dear friend, Bill Henderson, who's a member of the Wyoming House, for being here with us. Bill, thank you for joining us. If you would like to jump on and just say hello, we'd love to see your face, but we really appreciate you joining us for these presentations. Bill, Please say hello quickly.
Hey, hello, and I just quickly like to say how much I appreciated the opportunity and the information, Noah. A lot of good stuff, very, very succinctly portrayed, and I look forward to the opportunity down the road, maybe have a cup of coffee with you.
Absolutely, I would love to. Thank you, Bill.
And thank you to the rest of you. We really enjoyed having you with us. Please join us on Thursday night and then again on September 6th at 9:45 a.m. for a presentation with Israel's first Haredi woman to become a minister in her history. Her story is fascinating, and I think everyone will thoroughly enjoy that discussion as well. Thank you to all of you for being here with us. Have a wonderful night if you're here in Jackson, or if you're in Sydney, have a wonderful day. Take care, one and all. Thanks for joining us. Bye-bye.
Thank you.
Thank you.